I think there's a view that this should be a tax on the super wealthy, but actually we're seeing that more and more what a lot of people would think of as ordinary or middle class families are getting caught in the net.
Hello everyone and welcome back to the Personal Investor Podcast. I'm Ed Monk and I'm joined today for the very first time by my Fidelity colleague Marianna Hunt to talk about inheritance tax. There have been some pretty consequential changes announced to how the system for inheritance tax will work in the future. We're going to be covering those today. We're going to be asking exactly how much you really need to worry about these changes and about inheritance tax in general. And we'll be introducing some ways to reduce your bill if you are affected. So that all said, Marianna, welcome along. How are you?
Good, thanks. How are you doing?
Yeah, very well, very well. Before we get into the technicalities of the IHT system and how it is changing, why is it, do you think, this discussion around inheritance tax often is as charged and emotive as it seems to be, especially given that actually only a small number of people, relatively speaking, really have to worry about it?
Yeah, that's such a good question. And for me, this is one of those classic kind of family argument over the dinner table type topics of conversation.
Yeah.
So there's essentially two schools of thought when it comes to inheritance tax. The first school of thought is that we have a big wealth divide in the UK, and if you don't tax inheritance, then the children of the wealthy will just stay wealthy. That wealth gap will never even out. The second school of thought is if you've worked your whole life, you've paid tax on every penny of your income, you've been sensible with your money, saved up a pot to pass on to your children, why should you then have to pay tax on that money again? And these are two just fundamentally very different worldviews, which is why those debates can get quite heated. And you can see there's not consensus on what to do about inheritance tax because actually lots of countries approach this very differently. Some don't even apply inheritance tax at all. So Australia, for example, Canada, they don't levy inheritance tax.
Yeah.
So it's very much not clear cut what you should be doing.
There's so much to say about this. I mean, on the international thing, that's really interesting. I was looking, who does levy it, who doesn't. There's a huge discrepancy. I mean, it's fair to say that lots of other developed economies don't have inheritance tax. I mean, in the US, it has estate taxes, but if you look at the thresholds you have to get enormous. To, it's like millions, right? $13 million more than that before it becomes an issue. So definitely the UK is choosing to do something that not every developed economy is doing. I mentioned at the start that a minority of people end up paying it. I mean, the stat that's always quoted here is that there's, I think, between 4-5%, it does change a bit, of estates have to pay inheritance tax. That's a normal thing, but you can unload that a little bit. It's forecast to go up.
Exactly.
And I think it's always worth saying each estate that pays inheritance tax, that might affect multiple people, right? Multiple beneficiaries to it. So more than just that 5% feel like it's an issue for them. And
definitely.
And the point around fairness, I mean, as you say, it's almost like a philosophical thing. It's like people see it as a double taxation, not unreasonably. They see it as a double taxation. And when I was checking polling on this from a couple of years ago, that's the issue. This money has been taxed already, and why are you taxing it again? That seems to get to the sort of heart of why people feel so strongly about it.
Exactly. And I think there's a view that this should be a tax on the super wealthy, but actually we're seeing that more and more what a lot of people would think of as ordinary or middle class families are getting caught in the net. And that's for a couple of reasons. So firstly, because the threshold, so the point at which you start paying inheritance tax, have been frozen since 2009, and values of assets have gone up in that time. Yeah. So actually the £325,000 threshold we have at the moment, if that had gone up with inflation, it would now be around £500,000.
Yeah.
So more people are getting caught in the net. And also, you know, a lot of places have seen enormous property price value growth over that time.
This is a huge part of it.
You might have bought what you thought was a very modest house in Brixton in the 1990s, but that could now be worth a significant amount of money and pulling you into that IHT net.
Yeah, and that's, and it gets to this point about IHT in particular. I mean, what you said about the thresholds is really valid, I think. Basically, it's been frozen. I've covered budgets for years and years and years. You've covered a few of them. I've covered more than you. And The thing that never ever changes these days is the IHT threshold. 325,000 sort of written in stone now, it seems.
And frozen till 2030.
Yeah, and continues to be frozen. But it's not like the system hasn't been changing, because that threshold has been frozen, but we've had two really, really important changes over the years. One was the transferable allowance, the fact that spouses and civil partners can transfer unused allowance between them. That actually makes it potentially much more generous for families overall. And the introduction, I think, 2016, 17, I think, of the residence nil rate ban. So this is extra allowance on top if you're passing on a family home. That's why when you add all those things together, people will often say you can pass on £1 million, within a family. And it seems like a very large amount of money. But if you unpack it, that it's quite a sort of heteronormative way of organizing the rules. Are you married? Do you have kids? Have you got a big family home? Then great, you can pass on a large amount of money. But there might be someone else that doesn't have kids, that maybe is a childless uncle or aunt and wants to pass that money on to a niece or a nephew. Suddenly everything that they can pass on is capped at like 325. So it's there's seeming unfairnesses within the system, and that's kind of part of this picture too, right?
Yeah, although there are very generous allowances if you want to pass on your money to a local community sports club. So if my dad ever wants to write me out of his will, then he can pass it on to the local cricket club.
Yeah, right. So, well, we're going to get on to some of the quirks and some of the ways you can sort of use the system, I guess, if you have an IHT problem. So we're here to talk about changes to the IHT system. Why don't you give us an idea? First of all, okay, let's start from the system overall. In 30 seconds, it's a very unfair thing to ask, but in 30 seconds, can you give us the really important features of the IHT system as it is at the moment?
Sure. So IHT, in essence, is a tax that you pay when inheriting the estate of someone that's died. Now, that includes their money, their property, their belongings. And you can inherit up to £325,000, as we've said, without IHT being liable. After that, IHT will be chargeable. But as you've also mentioned, if you're passing on your main home, the home that you live in, to children or grandchildren, that £325,000 goes up to £500,000. And if you're a couple, you can essentially pool your allowance and pass on up to £1 million.
Yeah.
Now, one big thing is at the moment, the government does include things like ISAs, savings accounts, etc., but it doesn't include unspent pensions wealth when it's calculating your IHT bill.
Yeah. And that's been a feature of the system for about 10 years.
Yeah.
I think when the sort of all sorts of pension changes came in around the pension freedoms, we've spoken about them on the pod before, that was a feature which suddenly made pensions more attractive from a financial planning IHT point of view. And it wasn't always obvious why that was, right?
And that's what's changing now. So it was recently announced that unspent pensions wealth will come into the scope of IHT, and that will drag a lot of extra families into that IHT paying bracket. So according to the government's own calculations, around 10,500 families that wouldn't have paid IHT before will now be paying IHT, and almost 40,000 families who would have already paid it will be paying more. So that's a big difference. And actually, for some people, this might be a bit of a double taxation again, because under the previous rules, so the ones we have at the moment, you wouldn't pay income tax on that unspent pensions wealth when you start to draw on it if the person dies under the age of 75. If they die over 75, you do pay income tax, and those rules will still apply. So if the person dies after 75, you might be paying IHT and income tax.
Yeah, and it leads to this sort of like mad high levels of a sort of marginal tax that we call it technically, where so your money and your pension, 40% is taken from IHT. Then potentially, if you die after the age 75, your beneficiaries are going to pay inheritance tax on that. That might be 40 or 45% if it's taken as a big lump sum amount. It could push them into that rate. Add that all together, you might have a 64, 67% rate of tax on that money. So it really, really, really matters. And because pensions have privileged, or they've been privileged from an IHT point of view, lots of people will have organised their retirement financial plans in order to preserve that money inside a pension, right? There would have been,
Absolutely.
And suddenly those plans might have to change.
Exactly. And before I go into that, it's probably just worth mentioning that when we're talking about unspent pensions wealth, what I'm talking about is wealth inside a defined contribution or
Yes.
DC pension, which
Yes.
is what most of us have at the moment. It's where you build up a pot over your lifetime and then you live off that pot, whereas defined benefit pensions work a little bit differently. But as you say, a lot of people's retirement planning will change as a result of this. So the previous tactic that a lot of people used was to draw income from their ISAs first in retirement, and if they could, leave the pension. And that had a double benefit. So first of all, withdrawals from an ISA are tax-free, so you wouldn't be paying tax on that. And also, if you could leave that unspent pensions wealth, you could then pass it on without inheritance tax being liable. Whereas with a pension, if you drew that income, then you've got up to 25% tax-free. After that, you would be paying income tax. So we had this double benefit. Now that second benefit is gone. And actually, it's not as clear cut as it's always best to take the ISA money first. It's very much dependent on people's individual circumstances. And if you're trying to work out the most tax efficient way of doing it, it's almost definitely worth speaking to a financial advisor.
And these changes to reverse that situation with pensions and IHT scheduled April 27, I believe. So there's still a bit of time for people to organise things. But of course, they will need to get ahead of it if they can, and if they have been organising their finances that way. Okay, so I said at the start that we would cover some of the ways that people might reduce their exposure to IHT if they have a bill they think coming. We should say here that none of this is personalised financial advice. If you do have an IHT issue in your finances, then you could really benefit from professional advice. We should always say that. That said, what are some of the ways in general at a high level that the system allows you to reduce your liability?
So the best way to reduce your inheritance tax liability is to gift money while you're still alive. Now, the earlier you start thinking about this, the better, because if you gift that money and you go on to live another 7 years after gifting it, it's a relatively straightforward process that should be IHT free.
That will fall out of your estate at that point.
Yeah. Exactly. Whereas if you don't live another 7 years, it becomes much more complicated. It might still be exempt from IHT, but it's dependent on you following lots of different rules and exemptions. And we don't have time to go over all of them today because we'll bore everyone to death. But a few examples of that are you can pass on, for example, up to £3,000 tax-free each year.
Yep.
You can also give up to £250 per person to as many people as you like, which is called your small gifts allowance.
Yes.
You can give up to £5,000 to a child for a wedding, but bizarrely, you can't then combine that with the small gifts allowance. So there's lots of kind of quirks and nuances.
So overlapping rules, different people who can get one gift,
exactly.
If they've got one, they can't get the other, all that sort of thing. And on that 7 years rule, that's the kind of famous one that people will have some idea of. It will remain in your state for a number of years, and then it kind of like slowly, gradually tapers out of it until you get to that point after 7 years when it's all gone.
Exactly.
Another reminder really to get going with the planning for this, because who knows what's going to happen.
And you see some really unfortunate cases where this goes wrong. I mean, I've heard examples where grandparents have gifted money to a grandchild for a house deposit. The grandparents then pass away. That money is now tied up in a house, and the grandchild does not have the ready cash to pay a massive IHT bill when it arrives.
Yeah, I mean, we haven't mentioned farms, right? And we don't need to because there's obviously a niche subject, but people would have seen Jeremy Clarkson out along with the farmers protesting that. That's to do with that sort of liquidity issue that comes up sometimes with estates where farmers didn't really have to worry about inheritance tax, but now suddenly they do. They might have to come up with like a large amount of money, maybe hundreds of thousands of pounds. Well, where do you get it? You can't just sell a bit of your farm. Well, maybe you can, but if you can't, that presents a real headache. You've written about this topic this week. One of the things you mentioned was the extra administrative burden that is going to potentially land on families as a result of some of the changes going on.
Yes, so this was a bit of a U-turn by the government, and it came out in recent weeks. Essentially, we had previously thought that it would be the pension schemes that would be liable for calculating and paying any IHT that was due. But actually, the government has said that it's going to be the families of the deceased. And that's a huge burden to put on grieving families at a really difficult time. They're trying to plan a funeral and all that kind of thing, because you have to track down all these different pension pots that the person would have had, get in contact with the companies running those pensions. So one thing that is really important to do is to make sure that you A, have a will, and B, ideally attach to that some kind of document that lists all the pensions that you have, which companies they're with, policy numbers, and all that kind of thing.
Yeah, and that's particularly true if you intend to use these allowances and gifting rules to reduce your bill. I mean, I know one of the ways that financial planners will often advise their wealthier clients, I think it's fair to say, in order to reduce their bill, is to use something called gifts out of regular income, which is where if you're able to gift money away, but it can be shown that it's from regular income, it's not from capital, and it's not going to affect your lifestyle too much, and it's kind of part of a considered ongoing plan, you can actually give quite large amounts of money away in addition to the other gifts. But those rules, for example, will require evidence after the event. Basically, you've got to have all these plans and the admin sorted if you're really going to use these rules, because it's your family that have to pick up the pieces afterwards.
Definitely. You have to be really fastidious on record keeping.
You do. Okay, well, we have covered absolutely loads there. There is more to say. We're going to return to these topics again and again. I'm just going to remind people that if they found any of this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or a share. It's going to really help people find this content that we're doing here. That said, Marianna, thank you so much for coming in. That is all the time we have. Thanks for joining me.
Thanks, Ed.